I fully expect that the house price peak will occur in 2026, give or take some months, and the end of the cycle will be 2028.
Meet Fred Harrison, the man who accurately forecasted the 1990 and 2008 property crashes, years before they happened. Now, he's predicting another crash in 2026. In this video, we'll delve into Fred's theory to see if his track record might hold true once more, and discuss how you can not only protect yourself, but also thrive amidst potential market downturns. Fred Harrison isn't new to the world of accurate predictions, having foreseen both the 1990 and 2008 property downturns well in advance. His insights have proven invaluable. Now, with his eyes set on 2026, it's crucial we explore the rationale behind his forecasts and what it means for homeowners, buyers, and investors.
2024 is an election year in America, the UK, other countries, and that will be the trigger for more money being poured in by governments. If new governments are elected, they will want to be appearing to be constructive and boosting the markets. So between 24 and 26, it will be the final phase, the rocket price rise era. Everybody will think that and breathe a sigh of relief and feel that the worst is behind them. And that's when the cycle, when house prices end and we head into the period of consequences.
Who is Fred Harrison? Fred serves as a research director at the London-based Land Research Trust. He's an Oxford-educated economist who, in 1997, made a startling 10-year prediction that pinpointed 2007 as the peak of a global financial crisis. It's safe to say Fred's insights deserve our attention. Fred was one of the first to discuss the property cycle, a phenomenon he studied over centuries of UK property market history. He suggests that each cycle lasts roughly 18 years, segmented into distinct phases, which we'll examine shortly. But first, it's important to remember that interpreting such theories involves personal judgment. Historical data can guide us, but how we respond, particularly to sensationalism often seen in the media, can vary significantly. Back in 2006, for instance, advice on securing 110% mortgages was rampant, and hindsight folly. Many fell into this trap, lured by flashy headlines rather than sound financial advice. If you're watching this, chances are you lean towards a more analytical, perhaps professional approach, unlike the amateurs swayed by clickbait. Let's delve into the 18-year property cycle and its phases, starting with the recovery phase. Post-recession, property prices stabilize at low points, attracting savvy investors drawn by high rental yields relative to price drops. Initially, securing mortgages can be tough as banks tighten lending in response to the market's perceived risks. This phase often sees a media frenzy focused on negative trends, yet it's arguably the best time for astute investments. The absence of casual investors creates a prime market for experienced ones to capitalize on low competition and prices. As the recovery phase progresses, more buyers re-enter the market, recognizing upward price trends and growing optimism. However, a mid-cycle dip typically occurs, often mistaken for the start of a downturn, as early investors cash out, temporarily stabilizing or even reducing prices. This dip is short-lived, usually lasting 1 to 2 years, before an explosive phase of growth happens. During this explosive phase, confidence surges, banks loosen their lending criteria, and an influx of capital fuels skyrocketing property prices. Media hype around the rapid price increases compared to wages encourages a rush to buy, pushing prices higher. Despite warnings from some analysts about unsustainable growth, the prevailing sentiment often overlooks potential risks. Overlaying this cycle onto recent property data, the patterns post-2007 financial crash are stark. Despite Brexit and other economic shocks, house prices continue to rise, defying negative predictions. However, recent trends suggest a slowing momentum, potentially aligning with Fred's forecast of a looming correction around 2026. To navigate future uncertainties, consider these tips. Plan for high interest rates. Always model your financial commitments at around 6% interest rates to ensure affordability under tighter conditions. This is called stress testing. The second tip is buy below market value. Aim to purchase properties at a discount or add value through renovations. This strategy shields you from regrets even if market timings are off. And the third tip is avoid panic selling. Maintain a long-term perspective on price trends, even if prices dip. Historical patterns suggest overall growth over time. Fred Harrison's insights into the property cycle offer a valuable lens through which to view potential future movements in the property market. Whether his 2026 prediction will hold remains to be seen, but by understanding and preparing for future outcomes, you can position yourself to handle whatever the market throws your way. If you found this analysis helpful, please like, subscribe, and comment with your thoughts. Stay informed and ready for future market shifts by keeping up with our latest content. I hope you've enjoyed this video, and as always, I'll see you on the next one.